Nvidia's best customers may be financing tomorrow's GPU sales with today's GPUs. Start with two supplied signals. A July valuation post said Nvidia had traded near 19.6 times forward earnings in late March, while expected fiscal year profit growth topped 70%. Another post grouped Nvidia, CoreWeave, and Nebius under an excess compute warning. Together, they expose the market's argument: spectacular growth can coexist with fear that too much capacity is being financed too quickly. My argument is narrower and more unsettling. When a cloud operator can fund accelerators against the future earning power and resale value of those machines, Nvidia makes the sale now while the buyer carries the utilization risk. A supplied social post relayed a $176 billion depreciation allegation aimed at AI balance sheets. That is an allegation, not a filed result. Yet it points at the hinge. Asset value can fall before debt disappears. Follow one GPU through the balance sheet, and the circle becomes visible. Picture the loop in 4 arrows. Nvidia sells accelerators. The buyer presents the hardware, its contracts, or both as a financeable asset base. Lenders advance capital against expected cash generation. That capital supports another hardware order. A supplied roadshow summary named Emerging Cloud Providers as one, Nvidia growth engine alongside AI labs and hyperscalers. My inference, expanding credit, can pull tomorrow's purchases into today's revenue. The word circular can sound like an accusation. Here it describes a feedback mechanism, not proof of fraud or secret coordination. The seller's product becomes part of the buyer's borrowing story. Borrowing supports more product demand. Demand reinforces the product's perceived value. Each step can look rational alone. Fragility appears when every step assumes the next operator will keep renting compute at attractive rates. CoreWeave sits where hardware demand meets balance sheet leverage. The supplied material does not document CoreWeave's debt total or prove a specific GPU pledge, so I will not pretend it does. CoreWeave matters here as the cleanest stress test in the proposed model. A specialized cloud must turn machines into booked compute fast enough to service financing and still support expansion. A supplied chart post said CoreWeave had been hit hard amid excess compute fears. Utilization, not chip supply, is the hidden variable. That changes how to read growth. In this model, time becomes inventory. Assign an idle accelerator no rental revenue while financing remains due, and the stress appears immediately. So the decisive question is not how many GPUs CoreWeave can obtain, it is whether customer commitments become durable cash before the next expansion bill arrives. Capacity wins headlines, cash conversion decides whether the treadmill speeds up or throws the runner off. A second cloud can copy the loop and multiply the same vulnerability. Nebius is the second test. The supplied source set supports only a market concern. One chart post placed NBIS beside Nvidia and CoreWeave in an excess compute discussion and described a bearish weekly move. It does not establish identical financing terms. My argument is structural. If Nebius converts newly installed accelerators into the justification for more capital, its path can rhyme with CoreWeave without matching it contract for contract. Replication turns company risk into ecosystem risk. One borrower failing is a credit story. Many borrowers using similar assumptions about utilization, hardware life, and refinance access creates correlated exposure. Their contracts need not match. They only need to react to the same trigger, weaker rental demand. Then, operators protect cash together, orders slow together, and lenders discover that collateral values they treated as separate were driven by one crowded market. Lenders see liquid collateral right until every borrower needs liquidity together. From a lender's chair, the pitch looks elegant. The asset sits inside a celebrated growth narrative, the borrower expects compute revenue, and the hardware appears useful beyond one customer. A supplied Nvidia roadshow summary listed AI labs, hyperscalers, and emerging cloud providers as growth engines. That breadth can look like diversification. My objection: every pool still leans on the same confidence that paid AI workloads will keep absorbing installed capacity. Now apply a haircut. If lenders decide a used GPU is worth less, the same fleet supports less borrowing. The operator must add equity, pledge more assets, refinance on harsher terms, or stop expanding. None requires a dramatic collapse. A change in confidence can tighten the next loan before rental revenue visibly weakens. This is why depreciation matters. It is also a story about how quickly collateral loses economic value. When demand slows, the circle does not stop. It reverses. Run the loop backward. Softer rental demand reduces cash generation. Lower cash confidence weakens borrowing capacity. Less financing cuts new GPU orders. Operators then compete harder to fill existing machines, pressuring rental economics and the resale story lenders relied on. A supplied chart post already framed Nvidia, CoreWeave, and Nebius through excess compute anxiety. It proves no crash. It identifies the market's chosen fault line, finance capacity chasing insufficient paid work. Here is the consumer angle. A glut could make rented AI compute cheaper, which sounds wonderful for developers and smaller businesses. But the bargain would be financed by losses somewhere else: cloud operators, lenders, or hardware vendors accepting lower economics. Cheaper access would not rescue the investment cycle. It would advertise that prior capacity was priced for demand that failed to arrive. Great news for a prompt. Bad news for collateral. The seller booked the upside first. Now ask, who owns the downside? In this model, Nvidia holds the strongest seat because the seller books a hardware sale while the buyer carries financing and utilization risk. That strength creates an optical trap. Revenue can stay excellent while end customer economics weaken because an intermediary may keep ordering with borrowed capital. The supplied roadshow summary called Emerging Cloud Operators a Growth Engine. My read: that engine deserves a financing adjusted lens. Ask who ultimately pays for each accelerator hour. Sentiment can hide that question. In the supplied social feed, one Nvidia post confidently named $300. Another predicted a 90% weekly crash. Those claims cannot both describe a sober base case. They are useful anyway. When debate collapses into moonshot versus apocalypse, the plumbing gets ignored. The plumbing says Nvidia's vulnerability is not only lower chip demand, it is financing vanishing after making demand look durable. The loop breaks wherever cash fails to justify the next loan. Watch the next reports through 4 questions, even if management uses different labels. Is installed capacity being rented? Are customer commitments becoming cash? Are financing terms tightening? Are hardware values or useful life assumptions changing? CoreWeave and Nebius need to show that expansion follows paid demand. Nvidia needs to show new cloud orders reflect usage, not merely available credit. These answers matter more than another heroic capacity target. So does the loop break? My answer: it already contains the mechanism. Financing accelerates the boom by converting hardware into borrowing power. The same collateral channel accelerates the bust when utilization disappoints. No secret meeting is required. CoreWeave and Nebius are the stress gauges. Nvidia is the revenue beneficiary and the stock with the most expectations attached. If cash starts lagging capacity, the GPU boom's favorite flywheel becomes its trapdoor. Subscribe for the receipts.